What if there was a way to realize gains in your investment portfolio, pay zero in capital gains taxes, and get a tax deduction on top of it? That's exactly what a DAF, a donor-advised fund, makes possible. And it's one of the most powerful, yet underused tax tools available to everyday investors. Now, this isn't tax advice, and everyone's situation is different, so it's always worth consulting with a tax professional or CPA for guidance specific to your numbers and your state. But understanding how a DAF works could save you tens of thousands of dollars in taxes. So let's break it down. A donor-advised fund is essentially a charitable investment account. You contribute assets into it, receive an immediate tax benefit, and then recommend grants to charities of your choice over time. Whether that's a church, a non-profit, or any IRS-approved organization. Now, you could simply take cash from a bank account and deposit it into a DAF. Put in $1,000, write off $1,000. That's great, but it's not much different from just donating directly to a charity. The real power of a DAF shows up when you contribute appreciated assets like stocks. Here's how it works. Say someone bought Apple stock at $100 per share and 5 years later, it's worth $300. A $10,000 original investment is now worth $30,000. If that person sells the stock the normal way, they owe taxes on the $20,000 gain. Most people do exactly that. Sell, pay taxes, and then maybe give a portion to charity. But here's the smarter move. Instead of selling first, that investor can transfer the full $30,000 position directly into a DAF. The result? They get to write off the full $30,000 as a tax deduction and pay zero in capital gains taxes. The charity receives the full amount, not a tax-reduced version of it. And here's where it gets even better. If that investor still wants exposure to Apple long-term, they can simply buy back into Apple with fresh cash. At today's price of $300. That resets their cost basis to $300, meaning future gains will be much smaller. Do this year after year, and taxable gains shrink dramatically over time. It's a fully legal, repeatable strategy that the wealthy have been quietly using for years. Now let's go through the key pros of a DAF. Pro number 1, an immediate tax deduction. The deduction is claimed in the year of contribution, even if the funds aren't distributed to a charity until years later. This is especially powerful during high-income years, business sales, or any year with large capital gains events. Pro number 2, capital gains elimination. Stocks, ETFs, and even crypto can be contributed directly into a DAF, completely bypassing capital gains tax, while still writing off the full market value of the asset. Pro number 3, the bunching strategy. DAFs allow multiple years' worth of charitable giving to be stacked into a single year. This makes it easier to itemize deductions in that year, rather than always defaulting to the standard deduction. And then, give gradually to charities over time. Pro number 4, tax-free growth inside the account. Funds inside a DAF don't just sit there. They can be invested in funds tied to the stock market, allowing the balance to grow and compound tax-free over time. This turns a DAF into a long-term charitable engine, one that can grow at 10, 12, even 15% annually, and eventually allow for giving at a scale that far exceeds what was originally contributed. Pro number 5, more than just cash or stocks. DAFs can accept a wide range of assets. Private business interests, real estate, crypto, restricted stock, and partnership interests. When structured properly before a sale, this can legally shield massive capital gains events, like selling a business, from taxation. This is one of the primary ways the ultra-wealthy use DAFs. Now, for the cons, or at least the important things to be aware of. First, contributions are irrevocable. Once assets go into a DAF, they cannot be taken back. The funds are technically property of the DAF itself, though the account holder retains the ability to direct where those funds are granted. Second, the account holder doesn't have absolute control. This is why it's important to research and choose a reputable institution. Larger brokerages like Fidelity, Charles Schwab, and Vanguard tend to offer more robust DAF options compared to smaller providers, and generally come with fewer complications when it comes to directing grants. Third, there are AGI-based limits. Contributions of cash are generally deductible up to about 60% of adjusted gross income, while appreciated assets are capped at around 30% of AGI. Any excess carries forward for up to 5 years. There are other nuances and rules that a tax professional can walk through based on individual circumstances, but none that make this strategy out of reach for most investors. So when does a DAF make the most sense? It's especially valuable when someone has a high-income year, is sitting on stocks or real estate with large embedded gains, plans to give more than $10,000 annually to charity, or wants to build a long-term charitable giving strategy that grows alongside their portfolio. Opening one is straightforward. Major brokerages like Charles Schwab, Fidelity, and Vanguard all offer DAF accounts. Schwab calls theirs the DAF Giving 360. There's no cost to open one. The basic requirements are a US permanent resident address, a social security number, and an employer's name and mailing address if applicable. The application process takes just a few minutes, similar to opening any standard investment account. Once open, the account typically appears alongside other brokerage accounts. From there, funds can be invested in a range of options from conservative to aggressive, depending on the account holder's goals and timeline. A common approach is splitting between a growth fund and a broad market equity index pool. A DAF is a straightforward, highly effective tool for anyone who gives to charity and wants to make every dollar count, both for their tax situation and for the causes they care about. As always, consult a tax professional to make sure it's structured the right way for a specific situation. If you want to dive deeper into donor-advised funds, check out the book, The DAF Revolution, Making a Difference in Our Modern World by Ted Hart. It's a clear, practical guide packed with insights from over 120 experts across finance, law, and non-profit sectors. You'll find a link in the description where you can listen to the audiobook for free with a trial. Definitely worth exploring if you're serious about understanding DAFs.